All right. Here's another just kind of simple illustration. These are illustrations that I create custom for each donor, similar to that pie chart where we've got those three columns. The first one where we're not gifting anything at all, the middle column where we're doing what most givers are going to do. They're going to sell the asset and give some cash after the fact. And then the final column is what we can do if we can gift pre-sale. So this is just appreciated securities. We've got $300,000 of securities with a $50,000 cost basis that we're looking to sell. In this case, we're going to look at what it looks like to sell outright, what it looks like to sell and give cash, what it looks like to give the stocks themselves. I am looking at kind of worst case scenario tax rates. So looking at federal income taxes of 37%, capital gains of 23.8. That 23.8 assumption is a 20% capital gains tax rate and a 3.8% net investment income tax. And then I don't know if any of you live in California. We've got a lot of donors that live in California with substantially high state tax rates. It can even be as high as 13.3%. And so this is a good illustration for you guys of kind of how much we can save in taxes with some of these scenarios. So again, first column is no gift at all. We sell the stocks outright. We have to recognize $250,000 of gain. I've got other income in here because that's going to come into play with some of our AGI limitations on that charitable tax deduction. But in this case, we don't have any kind of charitable tax deduction. So we're paying capital gains taxes on that appreciation. We're paying ordinary income taxes on our standard other income. And at the end of the day, the donor walks away with, in this case, $700,000. In the middle column, we are still selling the asset. We're still recognizing all this income, but now we are giving $300,000 in cash to a donor advised fund or to our preferred charity. So now we're still paying capital gains tax, but we are able to reduce that ordinary income tax rate. So the great thing about charitable deductions is you will first use it against your higher ordinary income tax rates, and then you'll use it against the lower capital gains tax rates. So we are first able to reduce that 37% tax bracket, and we have saved almost $150,000 in taxes by making this $300,000 gift to charity. So again, it's not a one for one. It's not a tax credit. It's a tax deduction, but we are able to use this whole deduction in the year that we made the gift. And at the end of the day, we're saving $150,000 in taxes. Between the donor and charity, we're getting way more funds to the donor and the charity. The final column, we are gifting these securities before we've sold them. And again, this can work with real estate or with privately held business interest, but we are avoiding all of the capital gains because the charity is the one that sold them and they don't need to pay those capital gains taxes. But we're also getting a fair market value tax deduction. That's the double tax benefit, avoiding the gains and also getting the deduction. So now we aren't recognizing any capital gains taxes. We're using our deduction to offset those higher ordinary income tax rates. And we have now saved more than almost $240,000 in taxes by making this one-time $300,000 gift. So way more money went to charity. We actually have more money in the donor's pocket. And the IRS got a significantly less portion of this transaction.